You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at @TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Unilever, RELX, British American Tobacco, Coca-Cola HBC, Barratt Redrow, and our US company of the week is Etsy. Sam, shall I kick us off with Unilever?
Absolutely. Favourite of the show.
Yeah, and one that I own. So Unilever had their full year results out with a 1.9% rise in full year sales to 60.8 billion euros. The group's 30 power brands drove the performance, with sales growth of 5.3%. Underlying sales growth was 4.2%, with volumes up 2.9% and price up 1.3%. Volumes grew by 2.7% in the fourth quarter, against 3% expected. Underlying operating profit rose by 12.6% to 11.2 billion euros, with margins improving by 1.7 percentage points to 18.4%. Free cash flow fell by 0.2 billion euros to 6.9 billion euros, and closing net debt was 24.5 billion euros, with a 3.6% increase from the previous year. The quarterly interim dividend was raised to 45 cents a share, up 6.1%. And a new share buyback of 1.5 billion euros has been announced and expected to be completed in the first half of the year ahead, with the sale of the ice cream division. For the coming year, Unilever expects to see underlying sales growth of between 3 and 5% and a modest improvement in underlying operating margin. In terms of the shares, they didn't react well and they were down 6% in early trading. In terms of valuation, Unilever has a market cap of £110 billion and trades at 18 times forward earnings, compared with a 10-year average of 19.3, and it has a prospective dividend yield of 3.5%. It's difficult. I thought these results were fair, and yes, it is a tricky consumer environment at the moment, and we're seeing that across the consumer goods companies. If we focus on the 30 power brands, they are performing well, and that seems to be the strategy with the new chief executive, doubling down on those, and they have been growing market share, accounting for 75% of the overall group's revenue. I think that was something that got lost with the last chief executive, and they seem to be going down an ESG rabbit hole to a degree and focusing on more culture issues rather than those core brands. I think also we've got used to the turnaround with Unilever, and therefore these results are, I think, a bit disappointing in contrast. Valuation-wise, it's certainly not cheap at 18 times forward earnings, but I think probably with the runway ahead, it's fair, albeit with these slightly disappointing results. Sam, what are your thoughts on these full year results from Unilever and the valuation at the moment?
I thought the results were pretty good. Firstly, I think it's important to highlight that the new CEO, I know we keep calling him the new CEO, he came in July 23, so he's been there nearly 2 years now. But this was his first full year. So I think for a first full year, I think the power brands are doing really well. And I think if the focus remains on those power brands, as it probably should do, that 1.9% revenue rise should be higher in the future, which is kind of what's happened in the guidance anyway. Operationally, I think they've done a very good job. I think the operating profit rise of 12.6% seems to have been quite easily achieved. I think it kind of shows just how much bloat there was possibly there before. And I think that was partly down to the lack of focus that you'd talked about. So yeah, I think it's just nice to see it. This isn't the best year Unilever's capable of, but I think for the CEO's first year, I think he's come in and he's done a decent job, and I think it's heading in the right direction. And for the first time in a long time, the business is actually growing, because when you look at the share price, it's at like £44 a share now, and it's still only at a PE of 18, or a forward PE of 18. Whereas previously, because they've been struggling for growth so much, it's kind of I'd say for the past 5 years, without looking at the share price graph, it's probably hovered between kind of 35 and 43, 44 pounds, but the earnings haven't really grown that much. So now the valuation is pretty similar to what we've seen, but the earnings have actually started to go up. So yeah, I think it's a good first year. I think if we're looking at the same kind of results in a year's time, it would maybe be a bit disappointing. But I think for a first year, I think they've done quite well.
Yeah, and just an additional point. So the brand and marketing investment now stands at 15.5% of revenue, which is the highest it's been in a decade.
Yeah, I think they're focusing on the right things now. And I think that's showing.
On to RELX then.
Yes, so RELX is a business that we have covered before, but I think it's probably not a particularly well-known business for most people in that you don't interact with it day to day. So for anyone who's not familiar with RELX, they are a global provider of information-based analytics and decision tools for professional and business customers. RELX services customers in more than 180 countries and territories, employs over 36,000 people, over 40% of whom are in North America. And they are in 4 markets, and they provide information-based analytics and decision tools for customers in risk, scientific, technical and medical, legal, and exhibition sectors. So they do loads of things, but it's kind of a lot of it is basically subscription services for professionals. So as an example, they own LexisNexis, which is very well-known professional service subscription in the accountancy and tax sector. So in my day-to-day work, if I'm doing a piece of advisory work for a client, we pay for the LexisNexis subscription, and that's, rather than Googling something, that is the resource that we would go to instead. And they do similar things, for example, for law. So LexisNexis is very, very good for law, but they've got all kinds of stuff. RELX provide it to insurance as well, and like academic institutions. So those are the main kinds of things that they're providing the data for. So they have come out with their full year results, and revenue grew by 7% on an underlying basis to 9.4 billion. A decline in print was more than offset by broad strength elsewhere, with exhibitions enjoying the fastest growth at 11%. Underlying operating profit was up by 10% to 3.2 billion, helping to drive free cash flow up slightly to 2.1 billion. Acquisition spend after disposals was 100 million, contributing to an increase in net debt from 6.4 to 6.6 billion. And they've proposed a 7% increase in the full year dividend to 63p, and they intend to increase share buybacks 50% to 1.5 billion in the year. However, that is on a market cap of 72 billion. So that 1.5 billion doesn't go particularly far. There was no specific guidance issued, but the company expects to deliver another year of strong growth in underlying revenue and operating profit, and the shares were broadly flat on the announcement of the results. Their fully digital products now account for 83% of group revenue, and over 50% of the revenue comes from recurring subscription models, providing stable and predictable cash flows. In terms of the valuation, the business trades at a forward PE of 30.7, and that compares to a 10-year average of 20.7, and the prospective dividend yield is 1.7% compared to a 10-year average of 2.5%. I think these results are decent. I think given the size of the business, I think a 7% revenue increase is probably about the best that could be expected. Underlying operating profit increasing by 10%, I think is pretty good as well. But I think for nearly 31 times earnings, I'd probably want a bit more from it. I think the issue is that because of that subscription model and the quality of the products and the moats they've got, I think it's a really, really expensive business, but you're paying for the quality. But it's a business I'd love to own. It's on my watch list. I think the products are quality. It's a very, very sticky product, but I wouldn't pay 31 times earnings for it. So yeah, a good year, but I don't think it justifies the price it's trading at. What about you, John?
Yeah, I mean, I think the numbers did very decent numbers. I would agree with you in terms of valuation. It's expensive, but that's presumably the perceived quality there. The question I was going to ask you as someone who doesn't use the products is, do you think this is sort of threatened by the likes of ChatGPT in terms of, for example, you mentioned access to sort of accountancy resources? Could you see a scenario in which those resources are kind of or sort of superseded by what could be accessed through, for example, ChatGPT?
based on what I've seen, and I've not had a play with ChatGPT probably for about 12 months now, but I think ChatGPT was like a useful tool, and I have used it sometimes at work for emails and stuff, but the issue is you need to know the answer.
Yeah.
Because it will pull stuff from the legislation and interpret it. And firstly, it might not interpret it in the correct way. And then secondly, it might not be pulling the most recent legislation. So when you search for it, something to do with like a tax query, for example, it will say this is based on legislation up to November 2023, for example. And the problem is, if you're giving advice on something or taking advice on something, it has to be up to date. I don't know what opportunities there are within AI to actually enhance the products themselves. So there's that side of it. But I think it is so far away from being at a point where you can just plug a query into, and as well, like every client has different circumstances.
Sure.
And you can plug a general query in, but if you've got someone who's kind of got like those years of client knowledge, sometimes they kind of know what they're looking for and they just need to go in and find the legislation, and ChatGPT might be a useful tool to use. But at the same time, there'll be stuff where I'm doing it where it's like, actually, I might even know which specific part of the legislation I want to check.
Yeah.
So ChatGPT is not really adding something, because it's more when you kind of know what you're looking for anyway.
Sure.
And in terms of like the navigation of like the library of all the data on there, it is excellent to use.
Okay.
I think its competition would more be, I suppose it's going to have different ones for different industries. But on the tax side, there's another business called Kroner Eye, which Work also provide a subscription to. And there's some stuff where Tolly's is better, and there's some stuff where Kroner Eye is better. So as an example, if I'm going through the legislation itself, or I'm searching HMRC's manuals, which is basically their interpretation of the legislation, I tend to use Kroner Eye instead, because I just find it a bit easier to navigate. But then, say, for example, I want to research offshore investment bonds and I don't really know a huge amount about it, and I just want to read a few chapters about how it works to get a broader overview, I tend to find LexisNexis slightly better for stuff like that.
Yeah.
But there's not really anything comparable like that, where at the minute my default would be to go to ChatGPT.
Okay, that's fine. Thank you for clearing that up, Sam. Shall we move on to British American Tobacco?
Yes. So it is a company that I own. So how are they doing, John?
So they had their full year results out, with sales growing 1.3% organically when ignoring exchange rates. Combustibles were broadly flat, with 5.2% volume declines offset by positive moves in price and product mix. New category revenue was up by 8.9%. Underlying operating profit increased by 1.4% to £11.9 billion. And the group's also taken a £6.2 billion charge in anticipation of a settlement of ongoing litigation in Canada. The group's free cash flow of £7.9 billion helped drive down net debt by 9.9% to £30.6 billion. The annual dividend has been raised 2% to £2.40 a share, with £900 million of share buybacks expected this year, as previously announced. Organic growth guidance is for an increase of around 1%, with underlying operating profit growth of between 1.5% and 2.5%. Both metrics are now below medium-term targets due to regulatory headwinds in Australia and higher VAT and duty rates in Bangladesh. And the shares were down 9.2% in early trading. In terms of valuation, British American Tobacco has a market cap of £65 billion and trades at 8.9 times forward earnings, compared with a 10-year average of 12.4, and has a prospective dividend yield of 7.3%. I think these results were a bit disappointing for the group, particularly with the £6.5 billion set aside for legal settlements in Canada. But that is the nature of the industry and the legacy of the industry that they're in. I think there's a lot still positive for the group, including the shift towards the new categories, which is still going very well. I think we've seen for quite some time that combustibles have been declining in the sort of mid to higher single digits, which I think previously we've been quite surprised that seems, since starting the show, that seems to have actually accelerated from the lower single digits now to the mid to higher single digits. But again, it is still showing some elasticity there. with the pricing power of the product and the fact that it's still got over 40% operating margins. I suppose there's a degree, and we've discussed this before, as to what the strategy is and how much the group does pump into new categories and how much it does do share buybacks or just pure and simple redistribute the cash to shareholders. But I don't think these results were terrible by any stretch. I think it's probably that charge in Canada that really sent the shares down. But I suppose in some ways that was one of the big outstanding cases left. I know there is always room for more, but perhaps that is some relief to the group to have that sorted now. And it certainly doesn't look expensive at 8.9 times forward earnings with the level of cash that it's generating. Sam, what are your thoughts on these results from BAT?
Pretty similar. I don't think there are any huge surprises. I think it would be nice to see, well, not nice, but as a shareholder, it would be preferable to see the volume declines at 3 or 4%, like when we first started the show. But given that a year or so ago, they were hovering around 7%, I think I'd take 5% as a shareholder for the volume declines. I think what was disappointing for me was the non-combustibles only up, where was it?
8.9.
New categories, only up 8.9%. I think that should be higher. Historically, it has been higher. I think British American have been doing a better job. But yeah, I think the non-combustibles, I'd like to see that growing a bit better, but then it is kind of priced to the point where you could argue the non-combustibles business is actually still irrelevant when you look at the pricing of it. But as a shareholder, I think for the dividend I'm getting and the numbers it's putting up, I'm quite happy continuing to hold. That being said, it has done quite well since I bought it. So even after this sort of 10% drop, I think I'm probably still up like 30%. And it must be at the highest it's been in. You have to go back to 2022 to when it was at similar levels. So it's still had a bit of a revival compared to what we've seen in the last few years.
Yeah, and just coming back on your point, one of the things one of your points, on on non-combustibles. So the group have had issues, I think, with the illegal sale of single-use vapes in North America, and that is dragging on their new categories.
I don't think it's likely under the current administration. However, you do wonder if a future administration might copy, for example, what we're seeing in the UK, where the single-use vapes are getting banned in any case, which, based on that, could actually be a positive for British American tobacco.
Let's see. Okay, so Sam, Coca-Cola HBC, how have they been doing?
Yes, so it's a company we have covered multiple times and have grown to like more and more, probably. I think the more we've covered it, although I think we liked it the first time too, in fairness. But for anyone who's not familiar, it's Coca-Cola Helenic bottling company. Used to be listed in Athens, but then they moved to London, and they have the bottling and distribution license for the Coca-Cola brand in the following countries: Armenia, Austria, Belarus, Bosnia, Bulgaria, Croatia, Cyprus, Czech Republic, Egypt, Estonia, Greece, Hungary, Ireland, Italy, Latvia, Lithuania, Moldova, Montenegro, Nigeria, North Macedonia, Northern Ireland, Poland, Romania, Russia, Serbia, Slovakia, Slovenia, Switzerland, and Ukraine. So Eastern Europe, a lot of developing countries like Nigeria and Egypt and stuff like that. So it's kind of an emerging markets play on Coca-Cola. So they have come out with their full year results, and organic revenue was up 13.8%, with volumes up 2.8%, and all of the strategic priority categories driving growth. Sparkling was up 1.5%, energy was up 30.2%, and coffee was up 23.9%. Organic revenue per case growth of 10.7% was driven by targeted revenue growth management initiatives. Reported revenue growth of 5.6%, with strong organic growth partly offset by FX headwinds in the emerging segment. There was further value share gains, with their share in non-alcoholic ready-to-drink up 150 basis points and sparkling up 20 basis points. Organic EBIT grew 12.2%, with comparable gross profit margin up 110 basis points to 36.1%. And they've also mentioned that they're now experiencing easing input cost inflation, Return on invested capital was up 190 basis points to 18.3%. And they split all the countries that we listed at the beginning into 3 categories: the emerging segment, developing segment, and the established segment. So for established, organic revenue was up 3.3%, and that was led by revenue per case expansion and positive volume, and organic EBIT was broadly flat. For developing, organic revenue was up 12.7% with strong revenue per case expansion and good volume progress. Organic EBIT grew 39.6%. And in emerging, organic revenue was up 23.3% as they utilised RGM initiatives to navigate FX headwinds while still driving solid volume growth. Organic EBIT grew 13%. Comparable earnings per share grew 9.5% to €2.28, supported by strong EBIT delivery. Net debt to comparable adjusted EBITDA is standing at 1x, which looks fine. And they've returned €226 million to shareholders since the start of their ongoing share buyback programme. That is on a market cap of £12 billion, so it's not a huge amount. The board of directors have proposed an ordinary dividend of €1.03 per share, up 11% year on year and representing a 45% payout. And in terms of the faster growing segments, there were 3 that I just wanted to go over in a bit more detail. So first one's the energy segment. So volumes were up 30.2% in energy drinks, making the 9th year of consecutive double-digit growth. They made good progress in all segments despite new regulation in Poland and Romania. In established and developing, they saw high single-digit growth driven by Monster. In emerging, they saw double-digit growth supported by Predator in Africa. Monster Energy Green Zero Sugar was launched in 16 markets with encouraging signs in the first year of launch. For the coffee segment, volumes grew 23.9% with growth across all segments. Their primary focus was on the out-of-home channel, which they made good progress in terms of customer recruitment, adding another 4,300 outlets in the year. They see greater long-term potential in the out-of-home channel and have taken steps to refocus their attention there. Premium spirits volumes grew by 31.8%, led by the developing segment. They expanded Finlandia vodka into 19 markets where they did not have distribution rights prior to acquisition. So this one, they don't just have the distribution for, they've just bought the brand outright, Finlandia vodka. Finlandia vodka is enhancing their premium spirits credentials. They also launched Jack Daniel's and Coca-Cola in a further 15 markets in the year. In terms of the valuation, the business trades at a market cap of just under 12 billion, has a PE ratio of 17.6 and a dividend yield of 2.38%. I think it's a really solid set of results. I like the direction they're going in. They've got a number of different avenues to carry on driving that revenue growth. You've got the energy, the coffee, and the premium spirits. They've started acquiring their own brands, which everything we've seen suggests they're doing a very good job with Finlandia vodka. We did like the business initially. I think it kind of took me a little while to understand what a high quality business it was, which is unfortunate because it wasn't too long after we started covering it that Russia invaded Ukraine, and that was 2 of their markets that were basically wiped out overnight, and the share price dropped about 25% in a day. So it's now, I think it dropped to almost £15 a share, and it's now £33 a share. I don't want to get anchored because I think it's an excellent business, and at 17.5 times earnings, you can make an argument for it. It's on my watch list. I'd love to own it. I don't really have any complaints about it. And I think it's a really, really great way to get exposure to the emerging markets, as we say every time. I just wish I'd bought it 3 years ago. I really wish I'd kind of been a bit quicker to see what a great business it was, because I do really, really like the direction that they're heading in. What about you, John?
I think very similar. I've basically been anchored at the same point as you and appreciated it more and more as we've gone on with the shows. It's definitely remaining on the watch list, but I'm probably not brave enough to pull the trigger at the current valuation.
But it's still not silly levels. I guess at 17 times earnings, it's not ridiculous, but at the same time, I think it's now at an all-time high. And I would like, I know we are just anchored, but I would like, I'd like to see it come down a little bit at some point. Whether I'd pull the trigger, I don't know, but it is a business I think I would really like to own at the right price now.
Yeah, no, agreed there.
Shall we move on to a business that you do own?
I do. So it's Barratt Redrow, formerly Barratt, and then they acquired Redrow in the last year. They've had their half-year results out, with half-year revenue rising from 1.9 to 2.2 billion pounds. Growth includes contribution from the recently acquired Redrow, and the group delivered 6,846 homes, down from a combined 7,777 last year. On a combined basis, underlying profit before tax fell from £248.8 million to £217.5 million. Net private weekly reservation rates rose by a third to 0.6, and forward sales totaled 3.4 billion as of the 2nd of February. Net cash fell 48% to £458.9 million, driven by dividend payments and investment in land. An interim dividend of 5.5 pence per share was announced alongside a £100 million share buyback, with the first £50 million planned for the second half. Total completions for the full year are expected to be between 16,800 and 17,200, and shares were up around 8.3% in early trading. In terms of valuation, Barratt Redrow has a market cap of £6.1 billion and trades at 0.77 forward price to book, compared with a 10-year average of 1.15, and it has a prospective dividend yield of 4.3%. I thought these results were a fairly mixed bag. Obviously very positive to see the revenue rising and net private weekly reservation rates up by a third, with forward sales totaling £3.4 billion, but disappointing with the total homes delivered down and underlying profit before tax falling. But the group is investing more aggressively in land, and it's aiming for 22,000 homes, new homes per year in the medium term. I think it's also quite strongly positioned geographically and across the market as well, with Redrow being the more upmarket homes and Barratt being more the entry level. And I suppose Redrow adding to Barratt that they've got those higher margins. And the group looking to trim a further £100 million in cost savings with the overlapping operations. I know we say it every time, but I think the structural imbalance supply demand in the UK and need for more housing with these big house builders, and Barratt Redrow being the biggest of those, as the solution to delivering that. So I think structurally they're very well placed, and I don't think the valuation is very expensive, and it's got a fairly decent dividend there too. So I like Barratt Redrow. I'm continuing to hold and hoping for things to continue to improve going forward. Hopefully, if you have some further rate cuts as well, that will stimulate the market further. Sam, your thoughts on these half-year results?
I thought they were mixed. It's nice that they have actually identified some cost savings, because I think often when these kind of businesses merge, they talk about a lot of savings prior to the merger or the acquisition that shareholders then don't actually see. So I do think it's quite nice that they are actually identifying them straight away, and that they are just returning that to shareholders. I think that's actually, I don't know, I guess it's quite a nice touch, really. But I think the results themselves were quite, like you say, mixed. I don't know if it's just because of like where they are geographically in comparison, but Taylor Wimpey's results, and I think even Persimmon's, were both quite a bit better, or I thought they were. I thought Taylor Wimpey and Persimmon, when we did them a few weeks ago, both had a really strong set of results, although I think Taylor Wimpey was the better one, was it? I don't know if it's just because of where they are in the market in comparison, or if it's where they are geographically, but if Taylor Wimpey can do it, I don't really see why they can't as well.
Would you be looking at the house builders as a sector?
Long term, I like it, but it's very, very cyclical. So I don't find it massively attractive. And I think even with Barratt Redrow, because what's the forward dividend?
4.3%.
4.3. You can get that in a bank. So you're not buying it for the income. I think long term, I think they've got a lot of tailwinds. I think in terms of the opportunity cost, I think there's always been other businesses I've wanted more. So, for example, I know the valuations are totally different. They're totally different types of businesses. I'd rather own Coca-Cola HBC before I had a Barratt Redrow in the portfolio. So I just guess in terms of, although they're good businesses, I don't think one's ever made it high enough up my watch list.
Fair enough. On to another company that you own, Etsy.
Yes, although I've not done particularly well on this one,
Oh no.
unfortunately. So Etsy have come out with their Q4 and full year results. For the fourth quarter, consolidated gross merchandise sales was $3.7 billion. So that's the value of everything that they sell on the platform. And all these figures are in dollars. And that was down 6.8% year over year and 6.9% on a currency neutral basis. Etsy Marketplace gross merchandise sales was $3.3 billion, down 8.6% year over year, as a result of pressure on consumer discretionary product spending, challenging year over year comparisons in a shortened holiday season, category mix, and a highly promotional, competitive retail environment. I think as soon as they start talking about shortened holiday seasons, it's never good. Etsy Marketplace gross merchandise sales was weak on a year-over-year basis in October and November, with a relative acceleration in December. Active buyers were 89.6 million, decreasing 2.6% year-over-year. We reactivated a record 9.8 million lapsed buyers, up 1.3% from the prior year, and we acquired 6.9 million new buyers. Gross merchandise sales per active buyer on a trailing 12-month basis was down 3.5% year over year to $121 in the fourth quarter. The number of habitual buyers was 6.4 million, and that's down 9.5% year over year. So from memory, I think habitual buyers were users that spent over $200 a year and bought over 6 things a year, or it's something like that, or it's basically the power users. Depop's fourth quarter GMS, gross merchandise sales, was the highest it's been since the business was acquired in 2021, contributing to full year gross merchandise sales growth of 31.6% as the marketplace benefited from share gains in the US and favorable trends in re-commerce. Consolidated revenue reached a record $852.2 million, up 1.2% versus the fourth quarter of 2023, with take rate of 22.8%. So although they're selling, people are buying less stuff on the platform because they've increased basically what they're getting from the sellers and the buyers as well. The amount they're getting more from a smaller amount of sales, so their revenue has actually gone up. Positive revenue growth was primarily driven by services revenue, with Etsy Ads the primary contributor as they continue to improve their bidding algorithms on behalf of sellers. Consolidated net income was $129.9 million, up 56% year over year, in part due to restructuring and other exit costs of $27 million, which were in there last year. So basically, it's easy comparatives. Consolidated net income margin was 15.2%, up 530 basis points year over year, and diluted net income per share was $1.03. They ended the year with $1.2 billion in cash and cash equivalents, and under the stock repurchase program during the fourth quarter, they repurchased an aggregate of approximately $260 million of 4.9 million shares of common stock. And they've said Etsy expanded margins and generated consolidated adjusted EBITDA of over $780 million. In addition, by converting approximately 90% of that adjusted EBITDA to free cash flow, the company was able to deploy a portion of the cash to reduce share count by 12.2 million shares. So for the guidance, they've said they currently anticipate that consolidated first quarter 2025 gross merchandise sales will decline at a rate similar to the year-over-year performance reported for the fourth quarter. So what was that? Sort of 6 to 7%. And the CEO, Josh Silverman, I think he's called Josh. Anyway, Mr. Silverman has said, "We are moving with urgency to increase buyer engagement, drive more sales, and return to GMS growth." So in terms of valuation, I think it's worth highlighting that there's now 114 million shares outstanding. So where they've bought back those 12.2 million in the year, that represents a buyback of approximately 9.7% of all the shares in issue. So that is coming down a lot. So you're basically getting a return to shareholders of nearly 10% a year. It's currently trading at a price to earnings of 22, but as we've mentioned previously, earnings are not the best way of measuring this business because it churns out so much free cash flow. The price to free cash flow is only 7.75. So it's actually cheaper if we compare it to British American Tobacco, which we covered earlier. I think it's actually trading cheaper than British American Tobacco at present. I think the issue is that Etsy's not as addictive as cigarettes are. I guess it's the market being forward-looking, but previously the numbers haven't been too horrendous. This is the first time where I think it's really ramped up the number of buyers dropping and the gross merchandise sales. It was much smaller, but it's still so cheaply priced that I think as long as it doesn't accelerate, you can still do very well. I would like to see them get that under control and sort of level it out a bit. And ideally, it's a business that should be growing. But I just think in terms of the product, I don't think there's really any competition for Etsy. I know you've got like Temu and stuff like that, but I just think it's junk on there. If you want like artisan or handmade or like unique gifts, I think Etsy's still the go-to place. And what I think will happen is I think Etsy has kind of carved out its own little niche on the internet in a similar way to eBay, where eBay does not dominate online selling by any means. But in terms of just selling stuff in an auction format, loads of people have come along and tried to dislodge eBay and they've not been able to do it. I think the issue is that if you're looking at eBay shares, there's probably not going to be any growth at this point, or minimal growth, because they kind of are what they are and there's not really much else they can do. And I think Etsy is going to end up as a similar kind of business, but at under 8 times free cash flow. I appreciate there's a risk that these numbers start accelerating further, but if they can stabilize those gross merchandise sales with the number of shares they're buying back, I just think it's really, really cheap. So on a valuation basis, although the business performance is a lot worse than when I bought it, so I'm down, I've bought it numerous times over the years, but overall I'm down about 30%, which isn't horrendous actually, given if you look at the share price, I could have been a lot worse off. But it's a very different investment thesis to when I bought it, but it's so cheap. I do still find myself liking it. What do you think, John, as someone who's a bit more impartial?
I think it's difficult because I take your argument in terms of valuation. What I struggle with, and mistakes that I've made in the past, have been looking at a company like Boohoo. I appreciate it's not the same as Etsy, and thinking that looked sort of very cheap. I wouldn't say it had its niche in the market, but in the UK, you had Boohoo and ASOS being the big two fast fashion. And in fact, with Boohoo, it was still growing when we both bought into it. And we thought, well, what on earth's going on here? Historical valuations looked very cheap. And I think that was the market being, more forward looking and seeing Shein and Temu coming through. And I wonder whether it's the same argument with Etsy. I take your argument in terms of how much cash it's sort of churning out, but that would be my worry. And if you are to get out and make a profit, if that trend did or were to continue, you may not have the shares re-rating. So that would, I suppose, be my concern.
Yeah, I think the difference is the product though, because ASOS and Boohoo, they were the lowest cost provider.
Yeah.
That was their selling point. That was their moat, effectively. So when someone like Shein comes along and they can do it for less, the whole argument just evaporates. And Etsy doesn't have that. I think it's actually now Fiverr's numbers are better, but I think it's a fairly similar business to Fiverr actually, where the numbers are flattering it because it's been so successful at increasing that take rate. And the issue isn't actually on the seller's side. I bet the sellers don't like the take rate, but they are still paying it because it's not the sellers that are the problem. The problem is the buyers are dropping off. And I know it's a bit of a chicken and egg thing where you lose too many buyers and all of a sudden the sellers will go as well. But I am biased because I do enjoy using Etsy so much. But like for Christmas and stuff and gifts, I use it all the time for stuff like that. There's loads of stuff you can get on it that you just cannot get anywhere else. And it's all like, some of it's just really, really high quality stuff as well. So I'm not aware of anywhere else I can get that cheaper. It's not like with Hargreaves Lansdown as an example, where I used the product and I liked it, but actually I was probably, although I still use Hargreaves Lansdown, but part of it was probably a loyalty thing, where because I had held the shares, I was using it more because of that. Whereas with Etsy, it is just the only place you can get those kind of products.
Have you looked or ever tried any of the Chinese websites?
I just wouldn't. I just kind of associate. It's just going to be tat, isn't it? It's not going to be. It's like mass produced. It's not handmade stuff, which is the stuff I'm buying on Etsy. And I'd rather have something that actually arrives and is quality. But I'm not aware of anyone else using it. Like I know people use these websites, but not for the kind of stuff like that you're getting on Etsy. So it's like, like for example, I got one of my Christmas presents was basically a map of the Roman Empire that someone had like printed off, and like they'd done it on like nice quality paper and stuff. And it's not quite unique because they're just running off these prints, but they're doing it on a like, high quality printing press. And like, I don't really want a printout from someone on Temu because I can just imagine what it looks like. And I think with Etsy, there is that, for me at least, there's that association with quality.
Okay, fair enough. So of the companies this week, what would be your top pick and what would come last?
So, I mean, on the valuation basis, I do want to go with Etsy, but I think in terms of business that's performed best this week, I think it would have to be Coca-Cola or HBC. I think it's a really, really good set of results and it's a great company. Least favourite, I don't think there's any bad businesses in here, but I'd probably go RELX based on the valuation, but their results were pretty good as well. What about you?
I think at the current prices, I think Barratt Redrow is quite attractive. And I think in the near term, things are certainly looking bright for it. So I probably would go for Barratt Redrow, although I appreciate the set of results that they've just put up aren't fantastic. And then last, probably RELX. It's not one that I'm that familiar with. I appreciate you use the product. So for that reason, I put RELX last.
Right, I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.